Hi, this is Sive Morten with the daily update on EuroFX. I post my exclusive market overviews with the key political and economical events, charts and important levels on the forexpeacearmy.com forums weekly. This short video is a response to rapidly changing situation on the currency markets and should help you to stay on top of the game and be profitable. I suggest you to visit forexpeacearmy.com forum and read my analysis for the week before watching this daily video.
Welcome back, everybody. So let's keep watching for gold market. Today, as usual, we have prepared the report where we have trying to understand the background for a gold market, and it seems that gold market should become one of the assets among the many others who actually could provide really the island of the safety in the nearest time in this muddy water where we were going, concerning the Fed policy, concerning the situation in the banking sector, United States and Europe. It's too many uncertainty, not only inside of the United States, because mostly all the analysts' speeches and headlines right now looks like more gambling rather than some clear background, clear understanding what's going on. Nobody understands what really Fed will do with the rate, with liquidity. We have made our suggestion, so we have put it in a report today, mostly just because, well, based on the fundamentals that Fed right now is actually caught on a dead weight. So they have not really big room for some maneuvers. Actually, they could only printing, just because they have to resolve the problems with the budget deficit, with the record negative trading balance, with actually decreasing demand for national debt and the negative interest rates, supporting against, again, the banking sector. All this stuff needs liquidity, and we think that they will keep printing. At the same time, we think that Fed will not make any drastic steps with the rate, because a drastic rate cut, as the market suggests, for 150 basis points up to the end of the 2023 is too radical solution, and it's pushed the interest rate levels deeper in the negative territory, and actually it will not resolve any problem with inflation and other stuff. My suggestion is that the Fed will keep hiking the rate. They will keep moving with the slow steps, 25 basis points, that's enough. But they will do it gradually, because, as I said, the problems is already here. Whether the rate will be 5 or 5.5, it really makes no big difference. Because even 5% banks already can't hold in terms of the long-term loan providing to the real sector, the production, manufacturing sector. In terms of the corporate real estate, it's already big problems in the provisions and really loans of these squares. So it's lots of problems, and I think that Fed hardly will make interesting steps. They probably will keep going with this printing where it needs to, and hiking. So that's how we will. It looks contradictory, but at the same time, it could give the Fed to increase the timing. So just extend time and see what will happen actually. But as you understand, the end anyway will be not really good, inevitably not good, either for economy and the bond market or for the currency. So no other ways exist. And in all this muddy water, as I said, the gold might be the real island of safety. This is only about domestic problems. We have also foreign affairs. As you know, massive refusing using of the United States dollar in mutual trading among the big countries. So guys, it is not a joke. It's just because, just imagine the population. India, China, Middle East, it's already the Saudi Arabia, Brazil, This is the concentration of the global population, the Middle East. So it's a really tight area that includes more than the 60% of the global population. That is a huge market. And then just taking together India and China, it's already half of the world. Bringing some Latin American countries, Russia once again. It's we probably could see the big depreciation of the United States dollar in real time. So it might be really fast, much faster than it was in confronting of the pound sterling and United States dollar that lasts actually for 50 years. This will be much faster. I think that the first fruits we could see as soon as the first contracts for mutual trading will be achieved, and probably year and a half, and so you will already see the fruits. Already right now, the part of the United States dollar in the foreign reserves dropped from the 72% to the 59%. It's really fast. So that's what we have actually on the surface. And with all this stuff, it's really for a gold market, it might be just must to have in your trading portfolio for in kind of the investments or something. Maybe it makes sense to diversify your currency portfolio. So if you hold investments in the Swiss franc, for example, Australian dollar, somewhere else, some part of the gold, it definitely will be useful, really handy in the current situation. Speaking on the technical side, if we'll take a look at the picture, in general, gold holds the bullish context. On a high time frame, gold wasn't able to move significantly higher just because it stands overbought on the monthly and on the weekly chart. And we should not be surprised if the nearest time gold will not jump higher than the 2010 area. It needs some time to abandon the overbought condition, and only after that it will keep going higher. At the same time, currently we have some signs that point on some consolidation before breakout. First of all, this is the triangle. Although on the weekly chart we do not see it, but on the daily chart we're getting the shape of the triangle near the top triangle. Consolidation near the top, it's always bullish sign. And take a look, market accurately stands above the previous top. It's a tight range. It doesn't show any big drop, big reversal. It just stands tight. This might be the energy building for common breakout. And with the dropping MACD, it also starts getting some feature of the bullish dynamic pressure when the trend turns bearish, but price action is not. Together with the reversal bar that we've got here, and if you remember the bullish grabber that we've got on the futures price, futures chart that we discussed last week, that tells us that in general gold keeps the bullish context by far. On the 4-hour time frame chart, it led us to deal with the same pattern, although here we do not have really fast action. It's a bit lazy. We prefer to get it somewhere on these kinds or even that kind, but unfortunately this is not really too fast. At the same time, despite that it was not too fast, it was able to let us to complete all the targets that we have traded in the last week, including the last A-B-C-D pattern that we discussed, if you remember. Particularly on the data release, as you can see, market has touched the OP and starting retracement out from the agreement area. So that we discussed on Friday. So here we say we have the pullback. And bullish context on the daily chart in general led us to keep valid the butterfly. So the next week, as we have the pullback started, and it seems right now it's a bit fast, I think that we should not be too hurry up with the new position taking and see how market will react on the major support areas. First of all, in 1965, if it will be broken, then 1959 is next major FIP support area. We could consider taking the new long position once market would change the trend on the hourly chart into bullish when it starts upward action, and then we will try and take position on some retracement. If the breakout will happen on both levels, market start dropping back to the lows, well, that will be not too good, and actually it could mean that maybe we are wrong with the butterfly, and we should wait for some deeper retracements and watching for some other patterns. In this case, we probably will have to sit on the hands for some time and see what will happen to understand what the context is forming and what the patterns might be in place. So that's in 2 words our trading plan for the coming week. First, that we're starting from is just watching for market response to the major support areas.